I'm going to teach you what the difference is between low resistance and high resistance liquidity. Make sure to follow me so you don't miss any future trading and life tips. So first, what is low resistance liquidity? Low resistance liquidity is when the market generates relatively equal close highs or lows in the market. Often, when the market takes out low resistance liquidity, we see an aggressive sweep through all of the low resistance liquidity levels that are near each other. Low resistance liquidity is a strong draw to target in the market. Now, what is high resistance liquidity? High resistance liquidity is when there is one standalone clear high or low where we previously swept liquidity. We will then want to trade away from the high resistance liquidity and have our bias in the opposite direction. How I like to use these concepts is take my trades when there is a liquidity sweep where we then put in high resistance liquidity. I then take my position to target away from that high resistance liquidity, and in the best scenarios, we then have low resistance liquidity in the opposite direction, which I use as my price targets. Here is a market example of how I would use this. As we can see, the market first accumulates where we are creating the low resistance buy-side liquidity levels. We then get a push lower to sweep an old sell-side liquidity level with a move back higher, creating high resistance sell-side liquidity. The market then trades higher to target the low resistance liquidity and trade away from the high resistance liquidity.